Good afternoon, everyone. I'm Leah Kolich, an investment counselor here at Real Wealth, and we are so grateful that you've decided to spend your lunch hour or maybe post-lunch hour with us today to talk about a great investment strategy, how to grow your portfolio using a self-directed IRA. As you guys know, we are always on the hunt for other resource partners and vendors that can help you develop an investing strategy. And so we recently brought on this new sponsor, Quest Trust, and we're joined today by Juan Deshawn from Quest Trust. Hey, Juan.
Hi, how's it going?
Juan is going to give us what I think is a fantastic foundational introductory course into investing in real estate with your self-directed IRA. I talk to investors all the time who have, done the right thing and stocked their money away into their 401ks and their IRAs, but maybe they're not getting the kinds of returns that they want, or maybe they've just lost a little bit of trust or faith in traditional investment vehicles, and they want to get that money reinvested in assets that they understand, in assets that feel fundamental, in my opinion, assets that feel a little more connected to what we all need every day, housing. So we want to bring this class to you guys today. For those of you who are in that situation, you do have to set up a self-directed IRA. You have to work with an intermediary to do this. And so that's what Quest Trust is. They are that intermediary who can help you get those funds reinvested into other assets, into real estate, hopefully. So Juan, if you'll go to the next slide for me, I'll read our disclaimer. And for those of you who joining this live, we're going to do this same way we always do. We're going to record it and we're going to post it to our YouTube channel and to the Quest Trust resource page on our investor portal. So you can find the replay there. If you're attending live, we encourage you to send in questions and interact with us. I'll be monitoring those during the webinar, and then we'll have a designated Q&A session at the end. Okay, so this may go without saying, but the strategies that we're going to talk about today might not be what's most appropriate for you in your specific situation. So as always, you want to consult with your own team, your own accountant, specifically or especially when we're talking about investing with a self-directed IRA. There are some unusual tax consequences. So you definitely want to engage with your CPA, your accountant, to talk about whether this strategy makes sense for you. Attorneys, you name it, consult with your own counsel to determine whether this strategy is best for you. As always, with any investments in real estate, past performance is no guarantee of future results. Juan's got some good examples that he's going to walk us through today, but they're not necessarily an indication of how your investments might go. So real estate purchases are subject to risks. We are making every effort to bring you guys accurate and clear information today, but know that the possibility of errors or updates always exists. All right, go to the next slide for us, Juan. I'm really curious to hear a little bit about you and learn a little bit more about Quest Trust. I love the idea of investing with a self-directed IRA. Juan, we were talking before we went live here, and I mentioned to you that I self-direct my IRA as well into some real wealth syndication projects. So it's kind of, I've seen the benefits of that passive investing strategy by leveraging this option. So I'm eager to hear what you're going to present today.
Yeah, no, thank you. And let me echo actually the disclaimer as well. So hi guys, my name is Juan Deshawn. I'm one of what we call IRA specialists here at Quest Trust Company. So what that means is just I'm the guy that most people talk to on the front end to ask questions about what you can and cannot do with IRA accounts, how to get started, what if an investment is eligible for an IRA, and so on and so forth. So that's my main day-to-day operation and what I'm doing every single day. But disclaimer, I'm not a financial advisor. So I know we kind of touched on that. And Leah, you said, contact your CPAs and attorneys. That's key. There's a lot of things, especially with retirement accounts and IRS publication, that are kind of in the gray area. And there are things that are not in the gray area. And I will tell you that today, what is right and what's wrong. But the gray area situations definitely have a counsel. We always say you have to have people as tools in your tool belt. I'm one of those tools. Real Wealth is another one of those tools, and then CPAs, attorneys, etc., are the rest of your tools that you should have as an investor in general. So just wanted to echo that. And then about Quest Trust Company. So we're a self-directed IRA custodian. So like you mentioned, an intermediary is a way to think about us. We allow you to invest retirement capital into private assets, alternative assets, and a lot of our investors do real estate. I myself included. Also utilize my Roth IRA account to make private investments. I'm not deployed in the stock market at all. I don't trust it, and I don't understand it well enough. And we'll get to that in a second on what you should do there. But just to give you an example, I was speaking to a client earlier, and he is fed up. He said he wanted to move on over, and I'll tell you why. And I think we would all be fed up if this happened. But he woke up one day, and it was 2 days ago, and he lost $400,000 in his traditional IRA account. He had a pretty sizable account. It was that small dip went down by 400 grand. I can't even imagine that. So he said, I almost threw up, Juan. I need to get out of this thing. I need to do something about this. And so what we are is we're here to educate people to make their own decisions and be informed on what the possibilities are. Because I believe that we believe retirement is pretty tunnel vision focused. It's have a 401k, it's invest in the stock market, have your employer match. Hopefully you have enough to retirement, but we'll find out that that's not necessarily true. And also we are huge on service. At the end of the day, we are servicing you. So customer service is a big thing that plays in our day-to-day life and role. And we want to make sure that we are fast and friendly. And that's especially with real estate transactions, fast, time is money. So going on to the next slide, and please feel free to, use the chat box, Leah, interject at any point in time. We want to make it interactive. I want to make sure we can answer questions as we go along. And I do have some case studies as well that we'll get to. But so this is kind of how I see that most people's vision is. Everything that you prioritize, and then retirement's at the very bottom. Especially the younger you are, the less you're even thinking about it, because you're so focused in your career, focused on the next vacation you're taking, focused on buying that new car, whatever it is. People don't focus on retirement at all. And to be candid, I wouldn't either if I was in this space and didn't educate myself on it. So I think that's something that has to change, and we are trying to do that and trying to kind of tell people, hey, you should be looking at these opportunities and what there is out there, because I've seen too many situations where someone of the age of 50 plus is looking to retire and they just don't necessarily have enough to retire, and they have never done those numbers before, and now it just cost of living is going up and up. Here's some examples real quickly on essentially what you may be looking for, right? So every single person is different. Me personally, I want to retire on the beach. I would love to do that. My family's Nicaraguan, and I grew up on the beach. I used to live in Miami. I've always been near water, especially, except now. I guess I'm here in Houston, Texas, and the closest one is Galveston. It's not that fun. But I want to retire on the beach, and so I need to figure out a retirement plan that can allow me to do so and have that lifestyle. Some people want to golf, some people want to be in the city, some people want to just have a farm with a bunch of acres of land. So you got to think about what does your retirement look like so you can properly plan. And I believe that the fact that you're on this webinar, you're thinking about that. You're thinking about accumulating wealth, whether it be inside a retirement account or not. Passive income is ultimately, I believe, key to allow us to keep living the lifestyles we want when we don't want to work anymore. So a few numbers here that I think are just helpful to kind of drive home that importance of retirement is the rule of thumb is you want to have 70% of the last income you had over the course of your retirement years in order to keep your same lifestyle. So if someone making $100,000 and looking to invest by age 65, which some people are looking to invest before and some are retiring after, you want to have at least $70,000 saved up for the rest of your lifespan. Right? Let's just say everyone's going to live really, really long lives, and say you need 30 years, right? What you're going to need at that point is 2.1 million. You need 2.1 million at the age of 65 to have $70,000 to spend year after year for the next 30 years, right? So think about that. Most of Americans, and you can Google the statistics, but most of Americans have less than $30,000 by the time they reach 65 saved up. It's honestly a staggering low number. Let's just increase that. Let's say you were making $140,000 before you retired at age 65. That just went up by 4.2 million, right? Now let's say you have $300,000. You're making good money. Now you need $210 to continue that lifestyle, right? You need $6.3 million to retire. So what we're seeing here is that there is an importance to retirement accounts, and what these vehicles of IRA accounts are for is to help you prepare for that. I don't believe a 401k is the only way you can do it. You need to have multiple outlets. But a 401k, IRAs, and Roths are definitely things that you should have in play. And you should think about what you're investing into so you can control that. The more control you have, I believe, the better possibilities or better return you will have as well. So what we want to do here today is we want to define some problems, and we want to answer. So we want to find some solution for these problems, right? So one is, how can I hedge? How can I hedge against inflation? How can I hedge against a down market, right? How can I control my funds? Most people understand that 401k plans, you can't touch them until you have separation, and really it's just kind of riding the wave until it is what it is kind of situation. But how can you control that? And there are ways to control your funds. And is your retirement account ready? If you look at your IRAs, if you look at your Roth IRAs and your 401ks, if you were to retire today, are you prepared? Or if you retire in a few years, is it in a trajectory path to give you that number that you need to keep living on? So those are some questions you want to ask yourself when thinking about those opportunities. So getting to the meat of the presentation and kind of to self-directed IRAs, what is a self-directed IRA? So it's very common that people will think it's a whole brand new plan, and it really isn't. A self-directed IRA, the term self-directed is a marketing term. It's actually made up. It's utilized to just differentiate, at least for us and most of the people in our space, to differentiate between an account in the stock market and an account investing into alternatives or real estate, right? For example, I've seen Charles Schwab call one of their accounts self-directed. Personally, I don't think it's self-directed. What they're describing is, oh, you can come in, use our platform, and you can go online and choose the stocks you want to buy. That to me is not necessarily self-direction. So don't get too bogged down on the fact that it's quote unquote self-directed, but when we're talking about it, I'm saying you are getting out of the market. You're now investing your funds in projects and investment opportunities that you are finding, right? Either the ones through your network that you're exposed to, or the ones that you're just finding on Google. Ultimately, there are a bunch of opportunities out there for investors, and you just have to go out there and find them. And that's kind of what, to me, self-direction is, deciding where you want your funds to go, right? And then we got to get into the benefits of it, right? So kind of going down the line here, diversification to me is when you have funds in the market and in, an alternative asset. To give you an example, I think a few years ago, there was a time where the stock market wasn't doing too great. I mean, right now it's not doing too fantastic, but the perfect example was about 2 years ago, and a lot of people in my network, in my group, were kind of complaining almost every single day that like stock market was down. And I was very calm. I was like, oh, I'm not really worried about it because I've diversified my portfolio. Most of my funds are not in that stock market sense. So yeah, maybe my HSA plan was down, but my Roth was doing fantastic because I did a note and my borrower was still paying 12% on a monthly basis. So I was fine, right? So I believe that diversification is key when you have multiple assets and you're able to kind of, again, hedge against a down market. Then the next thing is tax savings, and we'll kind of go through what kind of tax savings we have depending on types of accounts. But of course, IRAs come with benefits that come with tax benefits. Some give you tax deductions. Some are tax-free income if you use them correctly. Some can be used for educational and health expenses. So there are some tax incentives as well within these plans that we'll get to. Social investing, when I started at Quest, I thought this was kind of like I really didn't understand this too much. I thought it was cliche. But what it is essentially, when you're investing into especially real estate, like to say a turnkey property, you are able to go see that property, touch, feel, and kind of make sure your investment's physically there, right? So you're also not only kind of buying a physical asset, but someone's going to live in that home. So you're providing someone a home, you're providing the Labrador a place to sleep, they have a white picket fence, the family. It's socially investing into your community. And then if you're contracting out some contractors, then you're ultimately putting people to work also in your community. So it's also just investing in your general vicinity, typically in your area. And then lastly, I think the most important one is investing in what you know best. There are people on this webinar here that are here to learn, or this is your expertise, this is your bread and butter. And I believe that if you are utilizing your retirement funds or really any capital to invest in assets that you understand, you can most likely give yourself a better return. I mean, it's not guaranteed, however, it's just a better chances of getting that return you're looking for. So we preach that at Quest Trust Company a bunch. Invest in what you know best. So guys, before I transition to plans, please feel free to chime in any questions because we're going to change gears a little bit. We're going to talk about each individual plans. I like to categorize them into 3 different categories. And the first one is our personal plans. So these are plans that anyone can open as long as they have earned income. So we have my traditional IRAs and my Roth IRAs. So you'll hear every financial guru out there saying you should have a Roth IRA, you should have a Roth IRA. Most people actually have traditional IRAs, and I'll explain why. A traditional IRA, or in parentheses there, called a rollover IRA, is a pre-tax bucket of money. So most of America has their wealth in 401k plans that has not been taxed yet. When you leave a job, when you leave an employer, you have a few options. You have the option to take the money out. You're probably going to pay penalty and taxes. You have the option to roll it into your new employer's 401k if applicable, or C, you have the option to roll it over to a personal IRA account and then just use that account. So that's what ends up happening. A traditional IRA, like a 401k, is typically a pre-tax bucket of money. The money can flow over without paying any taxes and penalty, despite no matter how old you are, and you can continue investing it. The average individual will take that and just move it to a rollover IRA. It'll be with a Fidelity or Charles Schwab, and nothing much will happen. But to them, it's like, okay, I just didn't pay taxes, and that's all I cared about. But to a savvy investor, to you guys, it's going to be an opportunity to take those funds and invest them into the projects that you have within your network and you're exposed to, because now you have a personal plan that you can control. That 401k, you didn't have control, your employer did. So that's why traditional IRAs are very, very common. These plans, you can set one up from scratch, absolutely. There are contribution limits. What that means is there's a limit of how much you can take from your back pocket and put into the account. So if you're below 50, it's 6,000. If you're above 50, it's 7,000. So the IRS doesn't give you too much to play with when it comes to putting in money, at least for these plans. However, if you're coming from an old 401k plan, you can use the total chunk of change. The other one is the Roth IRA. Now, this is a fantastic plan. I think everyone should have one at some point. The earlier you start a Roth IRA, the better. I call these accounts a glorified savings account. The contribution limitations are exactly the same, 6,000 if you're under 50 and 7,000 if you're over 50. However, the cool thing and why it's a glorified savings account is because when you're putting money in, that money you're putting in is always available to you no matter what. So I'll give you an example. If I'm putting $6,000 in for the next 10 years, I'm gonna have $60,000 of money that I've personally contributed in the last 10 years. And then ideally, I've also been investing that. So that's $60,000 that I've been putting in and then investing. Let's say the total account is 100 grand. If I get myself in a bind and I need money for whatever reason, I can still tap into that money within the $60,000 that I've personally put in at any point in time without penalty and taxation, because it's my money. What I'm not allowed to touch is my earnings, what I've earned from the investments. So I like to express that because, especially when you're starting early, you may be, I don't know, I don't want to put money in my Roth IRA because what if I need it, right? But at the end of the day, understanding that those funds will be available to you if you definitely needed it without penalties and ramifications might ease you into the opportunity to kind of start contributing to your Roth account. And then the earlier the better. If you have children or grandchildren that have earned income, they can set them up too. I was speaking to a client just earlier today that set up a Roth IRA for her 3-year-old. She's an entrepreneur, she's self-employed. Her 3-year-old was doing modeling services for all her ads, right? I'm sure they're the cutest pictures ever, right? We know she's not really working that hard. Mom's just snapping pictures. But if you give her earned income, now this 3-year-old has income to be able to compensate for the contributions that the parents are probably making for her to her Roth IRA. So starting off your children or grandchildren with a Roth, they won't understand it, but you're doing them a huge, huge favor, right? I wish I had that opportunity myself. There's a bunch of cool things you can do with Roth IRA plans and take money out if you ever need it for your first home, for example. So cool stuff there. But those are kind of the personal plans and probably the most common that we see. And of course, they can be self-directed. Those rules that I talked about are the same no matter where you have them. Those are just IRA rules. So transitioning to employer plans. So anyone here that may be self-employed, have their own business, maybe a few employees, maybe none at all. There's a few different plans out there that are available to you because you don't have that 401k or that corporate employer providing you with those benefits of 401ks. So if I was self-employed, didn't have Quest, what can I do to provide myself that? Well, I can set up 1 of 3 accounts depending on what I'm looking for. The most common one probably is a SEP IRA plan. This is very common with realtors or people who are just, basically they're their own employer. It's me, myself, and I. the lady who cuts my hair, she's self-employed. She can have a SEP IRA, right? She just has her own little studio. She cuts hair. That's another example of a self-employed person. And a SEP plan is fantastic because what you can do, it's very cost effective. It's low maintenance. It's basically a traditional IRA on steroids. It allows your employer to set up a traditional IRA for you basically and contribute based off of what it pays you. So if you're reporting $100,000 of income, the employer can come in and contribute up to 20% of that. So $20,000 can be deposited yearly for making 100 grand into a SEP plan for you. And that's pretty powerful because you can have that in conjunction with your Roth, in conjunction with a traditional IRA. You can put a lot of money towards retirement. The simple IRA plan is for smaller businesses. And there's a rule, actually, we can't have more than 100 employees. So the easiest thing I think of here is think of a dental practice or your doctor's practice. They probably have a simple IRA plan because what happens is they're small businesses with 8 to 10 employees, and this is kind of like a mini 401k. It allows the employer to come in and do a matching incentive plan, and it allows every employee also to contribute from their pay. So what that does is it allows the freedom of the employees to contribute how much they like. Once it's in the account, they can do whatever they want with it. They can self-direct it. They can have it in the market. They can even take the money out and run with it if they don't care about penalties. They can do what they want. And it allows the employer to incentivize their employees, offer benefits, and still offer a matching program. So it's pretty neat. If you're out there with any employees and you want to offer something like that, I suggest discussing that with your CPA. And then the solo 401k, probably a very coveted plan, maybe even discussed, especially when we're talking about syndications. We see solo 401ks are very common used account types because of a specific benefit it holds over these other accounts. A solo 401k, the way I think of it is, in the name, it's a 401k for just you. And you are able to take advantage of all the bells and whistles a corporate 401k plan comes with. Massive contributions, up to $61,000 a year. But you're also able to control it 100%. You are able to be the individual, the trustee of the plan that directs those funds, decides where the money goes, makes all the investment choices, signs on the documentation. It actually takes away almost the role of a custodian because you end up taking up that role. So it provides you a lot of power with the opportunity to save to retirement and invest it however you see fit. With those plans, there is a class that I teach that is an hour alone. So I just want to kind of snippet it and just say it's a massive plan that is very advantageous for anyone who's self-employed and has no employees and looking for the ultimate freedom, but responsibility. You know, if you're looking for freedom, but you don't want to do bookkeeping or record keeping, it's not a plan for you. And then lastly, 2 accounts that are pretty neat and different. You may have heard of these. HSA plans, so individuals with high deductible health plans are eligible to have an HSA plan in conjunction. So essentially what it allows you to do is allows you to contribute to this plan, and your contribution limits will vary based off of if you have dependents or not. If, for example, I don't have any dependents and my contribution limit is $33,650, and if you have dependents, it's double that. And what I get to do is I get to contribute how much I want up to that limit and take a tax deduction on that contribution. And then I'm investing it. And the cool part is if I take money out of my HSA plan, as long as it comes out for the qualified medical expense, to give you an example of what that is, my glasses, for example, I shop at Warby Parker. I can use my HSA to pay for my glasses. And that comes out completely tax-free. So what I'm doing now is I'm putting money in, getting a tax deduction, and then taking money out to pay for medical expenses without paying taxes. So it's honestly the best of both worlds. And then if I'm investing it and if I'm using my money for my investments, then now I'm using money I didn't even put in and still coming out completely tax-free. So it's a very, very neat plan. If used strategically and wise, it can grow to a sizable account. And I think the coolest part is actually what it can do for you in the future. Most HSA plans, they start off small. So most people, what they'll do is they'll just pay things out of pocket, or they'll use their high deductible policy and just pay things out of pocket because their goal is to grow the account as much as possible. And the reason why is because let's say you're able to grow your account to a pretty sizable amount, say $30,000, $40,000, $50,000. And this is 10 years from when you started it or 15 years from when you started it, you can reimburse yourself for any medical expenses that occurred since you've established that HSA, tax-free. What does that mean? You've already paid those expenses. You now get to reimburse yourself and take money out completely tax-free out of an HSA for that medical expense that occurred and has been paid for, so it's just money you take now. So it's a really, really, really neat process. Our president actually used that same strategy to pay for repairs on a small one-prop tail dragger airplane that he flew. It was one of those planes that if you walked up to it, you would tell someone, I'm not getting on that. And he had one of those, and it needed some repairs and cost $30,000, and he uses HSA to reimburse himself for it. Pretty neat. So the point is there is that if you strategically utilize these plans, you can be reimbursing yourself for some medical expenses. Everyone has medical expenses, so or use it like myself. And what I end up doing is I have some funds with Bank of America and HSA, and I use my debit card to swipe at Walgreens, and then I invest the rest. And the idea behind it is to eventually reimburse myself for whatever may come from here to them. And then we have the ESA plan, the Covered Out Education Savings Accounts. This is the only plan out there for children under the age of 18 that don't have any earned income. It allows the parent or guardian or even grandparents or anyone honestly can contribute to the plan for them and invest it, and then any money can come out to pay for any qualified educational expense for that child. That is tuition, books, uniform, etc. But it also is things like supplies, like a laptop, is agreeable, because these days you probably need a laptop to do your homework, or kids have iPads when they go to school now. So things like that could even be paid for by an ESA plan. However, this one is a small contribution limit. It's $2,000 a year. So what it does is it is better used whenever you start it very early, so that you can contribute every single year for the child, invest it as you move forward, and then eventually take some money out for their educational expenses, and whether that be elementary, middle school, high school, or college, you name it. So pretty neat plan there. I have some, in my case study, there's an example of where an ESA partakes, and you'll kind of see how people end up using it. We'll discuss more of that. But Leah, how am I doing? Any questions so far? Any confusion? Going too fast?
No, you're doing good. The questions I'm seeing coming in, I know you cover in future slides, so I'm gonna hold them.
Cool. All right, just drinking some water.
No problem. I want to give us a little bit of a time check. We're about halfway through the hour, and we do want to leave time for questions. So just so you've got that pulse check.
All right, we'll go full speed ahead. All right, cool. So restrictions on IRA accounts. So before we get into what you can do, I want to talk about what you cannot do. So we want to discuss, I think understanding what you cannot do in IRAs is key, because that's where you get in trouble. That's where the IRS comes knocking on your door. We do not want IRS knocking on your door. So we have three things called people restrictions, transaction restrictions, and investment restrictions. And when I say we, I'm going to rephrase that. The IRS has three things. We just follow the rules. People restrictions, transactions, and investment restrictions. So there are some people that you can't invest with, there's some transactions that you can't do, and there's specific investments that you cannot make, right? So people restrictions, I want to make it real simple, are people who you cannot invest directly with. So to give an example, I can't loan funds to this person, I can't buy a home in my IRA, and this person can't live in there. So basically, if my IRA is directly impacting this individual and transacting with that person, it's what we call disqualified. So people, it's primarily yourself. I can't loan money to myself. I can't invest into my own companies or projects with my retirement accounts. Then it goes down to your spouse, your children, and your parents, and even your grandparents. So kind of what it does is your lineal ascendancy up and down the line, and then it goes to your spouse, and then also if your children are married, them too. So what it's doing here is the IRS is saying that those individuals are what's considered a fiduciary to your account. If you pass away, typically the funds, the IRA gets inherited in that method to a spouse, to a children, to parents. And so they automatically disqualify those people because they already have kind of a interest in that plan, and it's going to benefit you somehow if you're investing into their company. So they want you to kind of have that separation. So never look to invest into your son's project or your father's company. Transactions, is really what you cannot do with those people, and that's buying, selling, trading, or extending a service. So buying is pretty easy. You can't buy a property for them or from them. Sell, you can't sell them a property. Trading, you can't do any kind of investments with them. And then lastly, extension of service, which I think is the IRS's gotcha card. because it's not very well defined. And so we have to go to this interpretation, we have to go to court cases and kind of study those to really define what is extension of service. The best way I can explain it is this: if you are a IRA owner and you invest into a property and that property needs lawn work to be done, you can do one of two things. You can hire a contractor, or you can just do it yourself because maybe you enjoy lawn mowing. However, if the IRA owns the property and you go out there and you go and fix the lawn and fix any other repairs that have to be done in the property, theoretically, the IRS can say, hey, this is an extension of your services, of your time. You're contributing your efforts to benefit the IRA to avoid the IRA having to pay an expense. So what happens here is they want you to contract that out. They want you to utilize the IRA like if it was another person. You can't be doing it any favors. And so the IRA has to go out and contract, and should be contracting someone to handle those kind of repairs, even mowing the lawn. Now, I get clients all the time that ask me, like, can I just go to my land? You know, I want a bunch of land. I want to show some people. Am I even allowed to step foot on it? Of course, right? The IRS is not in the bushes. It's not going to be watching you. I think when people cross the line is when when they get caught is when you own a roofing company and you need a whole new roof and your roofing company does the repairs for your IRA's property, right? That's just a blatant prohibited transaction. You have exercised your services and done a benefit to your IRA, and they're going to catch you there either doing a prohibited transaction or a excess contribution, because they're going to consider what you've given the IRA, which is the service, a contribution, and penalize you some way in some form. So you kind of want to just avoid that. So the best thing to think about is
that would include like self-managing, like if you couldn't self-manage your own property.
That's a great question. So that one, it depends on how, I guess, hands-on you are. So I get that all the time where clients even have Airbnbs in their IRAs or just rental properties. Can you vet the tenants? Absolutely. You know, make sure there's no murderers in your house, right? So that's not a problem. I think it's just, and it's even one property and you want it, if they text you for any problems, I don't think it's going to cause you any issues. I believe it's really when you go out there and you start doing large repairs and projects on your home that you should contract out. If you are in the position where you have 3, 4, 5 different properties and it's like a business for you to be property managing these properties, and I would at that point probably get a third party to do it. If you're acting like a business, and the IRS can come and say, hey, you're running a business in your IRA. So if you're doing one, I don't think it's that crazy, but if you have 2, 3, 4, 5, it could get a little dicey on the gray area.
Yeah.
And then lastly, investment restrictions. So the IRS only said that you can't invest into 2 things, right? So that's kind of what we're doing here. We're trying to show you that there's so many possibilities out there. It's not just a stock market, but there are 2 things that you can do. And that's life insurance policies, right? So they don't want you investing and gambling on someone dying. And then 2, collectibles. So a collectible can be like art, and they kind of cancel that stuff out because it's very hard to value, right? A piece of art to you may be $100,000. To me, it might be worth 75 cents. So it's just, you don't want to do any collectible type of purchases in your retirement account. But yeah, those are the only 2 things that they say are investment restrictions. Let's move along here. What I've thrown at you thus far, just a kind of little break in between, it is very complicated sometimes, and there's a lot more to it, and we're kind of just scratching the surface level. But just understand that our role here is not to tell you what to do, but to educate you. So if you ever have questions, you can call our custodian. We'll answer any questions, meet with you. We don't charge to do that. We're not making money as advisors or anything like that. We're here to answer those questions. So just keep in mind, at my team here in Houston, there's 8 of us. There's over 30 employees that are certified IRA services professionals, which is just a certification that we get from the Association of Banking that says we're nerds and we know a lot about IRAs. And then there's even a live chat, and the live chat is run by us, my team actually, that is here in this office, and we'll on the chat from 8:30 to 5:30 Central to literally chat with you immediately. If it's a super hard question, we will probably just ask you for a phone call. So what we see here at Quest Trust Company before the case studies is 3 different categories. So we have real estate, private entities, and promissory notes. These are probably the most common investment choices that we see here at Quest Trust. Real estate are anything when you're taking title, deeding a property under the name of the IRA, single family, commercial property, options, tax liens. Private entities, probably the most popular right now. LLCs, joint ventures, this is syndications, right? Syndications are Very, very popular in this time. Debt funds, equity funds. And the right reason why I think so is because they're passive investments. I think of them one-way streets. I'm sending my money out to this investment, to this LLC. It's doing X project with X return, and it's going to pay me back, right? It makes a lot of sense for retirement accounts, not very transactionally heavy. And then promissory notes always stays pretty constant up there, right? Promissory notes are an agreement between you and a borrower. You end up becoming your own a personal bank, a private bank, and essentially negotiating some terms. That's something that I've done personally, and we'll jump into a case study to explain that. So the purpose of this case study is not to wow you guys on a home run deal, and I don't even think this is necessarily a home run deal. It's to kind of get some concepts in place. So what we have here is a family. This is very common. It's a family who have, husband, wife, child. They have accounts. The child has an ESA, right? They're looking to buy a property, and that property is for sale. I'm pretty sure here it is. The purchase price is 100 grand. I'm around the numbers here. And then what they have to do is an older property. They estimated some repairs, right? So $30,000 of repairs estimate. So they have $130,000 to accumulate. Now they didn't have that in one single go, but what they've been able to do is accumulate those funds with multiple IRA accounts. You can do this project with one IRA account or 3 or 5. I've done a project with 9 before. So the thing is, you can be very, very creative when it comes to real estate, like turnkeys and notes. With syndications, typically those are going to come with minimums that you have to meet, and typically that is on a per IRA basis. So I just want to throw it out there. But so what happened here is Robert, Linda, and their son all have funds. As you can see, the breakdown is here to make up the full $130,000. So they're going in with a 60, 35, and 5% split. What that means is any expenses associated with this rental property moving forward will be paid out in those percentages. Any returns associated with this rental property will come back in those percentages. So if it's giving you $100, then that's going to be $60 to Robert, $35 to Linda, and $5 to the son, right? So it always has to go to and from in those same percentages that they went in. Essentially what happens here is the deed to the property will look like this. The name and the owners of the property are not you. It's not Robert Jones. It's the IRA of Robert Jones. And these have legal names. And so on the contract, this is what you'll see. It gets fairly lengthy, but it'll always read Quest Trust Company or the custodian you're working with, FBO, which stands for the benefit of, the name of the individual, IRA, and you'll always be designated an account number. In parentheses, this is important, it has to have this language, and it says always as to an undivided interest of whatever that percentage is. And the reason why it's undivided is because you can't say Robert's IRA gets the living room and Linda's gets the kitchen, right? So you just can't do that. But that's exactly what we would see here from a Quest and a custodial standpoint. Any custodian you're working with, that's the biggest thing they're looking for when you're doing projects, whether it be a rental property, whether it be a syndication, whether it be a note. The vesting is what it's called. The IRA's name is important, and it has to show correctly. And then your custodian will sign on behalf of your retirement accounts. What happens is you as the clients will read, approve the agreements, negotiating all terms. You're doing everything on the back end. We're just, again, making sure it's done correctly to the IRA, representing the IRA, and then sending funds out at your will. So as you can see here, essentially what ended up happening, there's monthly rent that will be split in a 60 to 35 to 5 split. All expenses are paid by IRAs. And then all of them are also, I think kind of the bigger thing here is not really the cash flow, because there might be some expenses there. It's really the appreciation of the asset. 10 years down the line, they bought a house for 100 grand. That may be $200,000, $300,000, right? So that ESA at some point, 10 years down the line, will have a good chunk of change to be able to take that child to college and pay for that tuition, right? Because that's the ESA plan. So that's kind of what they're thinking here, is that's the game plan for this family here. Does that make sense?
Yeah, I have a question about this one that I've always kind of been unclear on. Your bullet there at the bottom says all expenses are paid for by the IRA. So are expenses divvied up in the same proportions between the accounts? And my second question is, do you have contribution limits with the, if there's not enough money in those accounts to cover the expenses that are there, are you also limited by the contribution limits?
Yeah, great question. So yes, they would have to be in proportion. So if there's a $100 expense, that would require that Max Jones covered ESA covers $5 of that, right? So absolutely. So we definitely run into the situation where what happens if there's not enough funds in it for those expenses? You definitely want to keep track of that. The contribution limits of these accounts for Jones and Linda, if they're below 50, it's $6,000. If they're above, it's $7,000, and for Max, it's $2,000. So that's definitely something you always want to consider before jumping in. What, do I have enough to take care of that moving forward? If the property is cash flowing, even better, right? I've had clients who just use a property management company that they take care of any expenses and then get reimbursed by the IRA, or they keep like a little escrow account to handle that whenever the time comes, and they can do that as well. So with properties, it is recommendable, honestly. It'll probably save you some headaches to have a pretty good property management company that has worked with IRAs before and experienced with that, because it's going to make it just easier on you to handle these kind of expenses. I have clients that don't use property management companies, and what happens is Quest's accounting department would receive an invoice for an expense to be paid, and then we would pay it out, and we would grab from each account as necessary, or as we have to. Does that make sense?
Yeah, it does. So, I mean, the thing that I always try to tell people is they'll be like, oh, I've got $100,000 in my self-directed account. I can go buy a $100,000 house. And I'm always trying to emphasize, well, you have to manage the home and care for maintenance and everything with that same account.
Yeah.
So you definitely want to have more than the price that you're deploying in the asset itself.
Yeah, 100%. You want to stick on the conservative side for sure when you're running your numbers and kind of what it would take for those expenses. Absolutely. There are some other things I won't get into now for the sake of time, but if you're over 72, there's also some things you want to consider if you're required to take some distributions out, but for the next class.
Yeah.
So real quickly, promissory notes. This is another thing that I'm going to fly through this one that I personally do as well, and I love it because it's easy. What OPI is other people's IRAs. So we always tell people that are borrowing money, don't just look at hard money lenders, don't look at banks. You can go to people's IRAs. You can go to people that are I mentioned people who you can't transact with, but I did not mention siblings. So keep that in mind. Your sibling could theoretically loan you funds from their IRA account or vice versa. Now, Thanksgiving might be weird if you default, but that's to each their own. So from a borrower perspective, it's awesome because you create a private financing source. There's a bunch of wealth in retirement accounts. And so just think about that if you guys are real estate investors yourself and looking for capital. But here's a note. And so this is a very common strategy. Essentially, it's usually a situation where a real estate investor is looking for funds, looking for a loan. They're probably going to do a flip. They just need the capital. And sometimes it can be a very short turnaround time, or maybe sometimes a longer turnaround time. Right? So completely up to you. All these terms are negotiable by you and the borrower. In this situation, what we're looking at here is a loan of $95,000. They have an ARV, estimated value of the property, of $127,500. So not bad, right? Ultimately, it's worth more than what you're loaning, right? You always want to consider that essentially in case you have to foreclose on them if you have a lien. What they've negotiated here is 2% points up front. So what that does is just, one, it covers maybe some expenses that you may have from an IRA perspective to your custodian. So you just covered your fees, so it's free for you to do this transaction. And for the borrower, it's usually cheaper because at the bank, they're going to charge you a bunch of different things plus blood samples. So they're usually happy to pay the fees. Interest rates, you can negotiate them, right? Typically, I see people do 1% a month. 8 to 12% is probably our average note that we see. So they're pretty solid interest rates as well. Loan terms of a minimum of 3 months. To each their own here, but ultimately, in my opinion, you want to at least deploy it for 3 months to make it worth your time. And so this is pretty simple, pretty standard note. And kind of the biggest thing here is that you can utilize multiple accounts. Like I mentioned, I did one that was $150-something thousand, and it was 9 different IRAs. I just did another one with $105,000. It took 4 different IRAs. So you don't have to have all the money out there. And if my young buck self can do it, anyone honestly can. You have to have that network and find those opportunities and use that. So just some key points to remember is you can't loan money to yourself. You set the terms, and you can do secured and unsecured. Now, I'm not here to offer advice, but I've seen situations where unsecured are very risky. And so, to each their own, but I personally do things with first lien position and secured for sure. So helps me sleep at night. So as we're wrapping up, because I flew through that one, I want to close it out here. Just keep in mind that Quest Trust Company does countless education. Our main goal is to educate. And we have webinars and networking events that you can partake in, no matter if you're in the Houston area where we are, Austin or Dallas, or just nationally. Most things are webinars anyways these days. So keep in mind that questtrust.com is a great resource for just learning more and blogs, etc. And then this is some contact information on how you can reach us. You know, live chat, call us, our email, my team's Ira specialists at questtrust.com, or like I mentioned, visit our events. We have in-person events and online ones. So, but yeah, I'll open the floor for questions, Leah.
Excellent. Let's get into some of these here. Get back up to the top. Okay, Dag wants to know, does Quest Trust allow checkbook control? And maybe explain for those who don't know what that is, what that means.
Yeah, great question. So checkbook control is a situation where the IRA, okay, so the IRA has to invest into an entity, like an LLC, for example, and the LLC's manager is the owner, the account holder, right? So say, for example, I, Juan Deshawn, create an LLC account that my IRA account is going to fund. What the purpose of that is I'm going to now have checkbook control, check writing ability to my retirement account, and I'm able to bypass the processes of a custodian and maybe even escape some fees. And I 100% understand that. And even sometimes with heavy transactional investments like a flip or a rental property, it makes some sense sometimes. In situations where it's no passive syndication, sometimes it's kind of like overkill. You're going through a lot of steps to kind of just do this thing that you can do with a custodian fairly simply. To answer the question, Quest Trust Company does not offer checkbook control with self-directed IRAs in the manner that I just described. We do have clients that bypass that by basically appointing a non-disqualified individual as the manager of that LLC or trustee of a trust if you utilize a trust. So I mentioned, for example, brothers and sisters are not disqualified, so it's very common that I would set up an entity, my brother would be the trustee, my IRA would be the beneficiary, and the funds would be sent over there. My brother is essentially the one that's going to be signing the contracts on behalf of the trust, making the investments, but we're close, so I trust them. So people kind of do that, and I'll explain the reason why. When going over prohibited transactions, you are a disqualified individual to your IRA, and so are your companies and things that you manage. So I think at the end of the day, all the rules the IRS puts into place is to avoid you having unfettered control of your assets, and you're putting yourself in a position that can be, I guess, just looked at to the IRS by having that kind of structure. So I see both sides. Quest stays on the conservative end, and we don't offer it.
Okay. Great answer. You mentioned the fee structure of a company that does what yours does. Yep. I know from my own experience of having interviewed several different intermediaries, the way that different organizations assess their fees can vary pretty significantly. Can you speak at all to kind of the fees associated with your services, at least in a general term?
Yeah, absolutely. So yeah, I've definitely even compared to myself. So I'd say it's a competitive fee structure. There are some companies out there, smaller ones, that offer, they might charge differently, whether it be a real estate asset to a syndication. We have kind of a blanket thing. We have 3 different options essentially that someone can choose from, and it always depends on size, activeness of the account, etc. To give you an average investor, someone who's going to bring in $50,000 to $100,000 and then invest that into a project, let's just use a syndication as an example, is probably looking at an annual administrative fee of $350 a year. On the front end, it'll be a little more expensive because you're paying these one-time fees to send wires out, to execute the contracts. But once you're finally inside involved in the investment, that's probably the average, $350 a year.
Okay. Excellent. All right. Isha wants to know, can properties be bought with loans in a self-directed IRA? The example you gave showed the family purchasing that home outright, but can you use leverage?
Yeah, awesome question. Love that. So yes, you can. The specific type of leverage that you would require is called a non-recourse loan. So there are specific banks that will offer this. If you went to your Charles Schwab, or not Charles Schwab, so if you went to Chase Bank and went, I need a non-recourse loan, they're going to look you sideways, probably be confused, say, get out of my face. So there are some non-recourse lenders out there, and it's definitely possible for them to loan money to an IRA account. What their requirements would look like is they're probably going to need a higher down payment. They're probably going to have a higher interest rate as well. It's just a riskier asset for these lenders. They're not necessarily looking at an IRA's credit. There is no credit. They're going to look at the available cash within the IRA. They're going to look at the asset in question they're loaning on, and they're going to look at kind of probably what your plan is for the investment and what your goal is, because it's really on a case-by-case scenario how these lenders lend. A lot of hard money lenders will do this, or like I mentioned, there's actually some national banks that do this as well. And I'm happy, just email us and we'll share a list that we have. But yeah, so you could definitely do that. You can definitely get non-recourse loans. Speaking to a few people, for example, a common structure of a non-recourse loan would probably be 30 to 40% down, and you're probably paying, in the 8% interest rate area, maybe a little more, because I think now normal interest rates are like 7% or something. I think. Yeah. So it's maybe a little higher than that. Yeah.
We do have. Yeah, we do have a couple of no recourse lenders on our website that we recommend. So if you're new to Real Wealth or don't know where to find that information, you can, when you're logged into the portal, hover over resources, and we have a whole section for no recourse lenders there.
Awesome. Yeah, they're usually super friendly too. So I suggest if you're just curious, call them and even inquire and like throw some hypotheticals at them. I do want to add one little piece though. And won't get into too much detail, but when you do non-recourse loans with IRA accounts, there may be taxation for the IRA. So just keep that in mind. That's a whole separate class, but an IRA could pay taxes in certain scenarios, and when they take on loans, they do, and on some of your profit. Typically, if you do your numbers right and the investment makes sense, the taxes won't be an issue, and you're not paying it, the IRA is. So just a little bit may go to Uncle Sam, but that's called UBIT. If you want to do some research on it, just not enough time to try to touch on that.
Yep. No, unrelated business entity tax. We've let people know to be aware of that. And it's a good segue actually to the next question that's asked. And it's, what are the tax implications for investing in real estate, in a real estate syndication? I want to be sure to reinforce, because I see there's many questions here that are tax questions. They're questions that should be discussed with an accountant, with your CPA, while Juan or myself might have some situational or circumstantial knowledge of these things. You definitely want to consult with your own CPA to talk about your specific situation. Because what might trigger some tax implication here for this investor might not for this investor over here. So you want to get your information from someone who's looking at your finances on paper and can give you good advice.
I will say though, for syndications and UBIT, and more directly UDFI, unrelated debt financed income, it's very common. It definitely is possible that would occur, and CPAs that understand it are key. There's not a lot of them that do and know how to calculate it either. So finding someone that can do that is very important. It was funny because I was speaking to someone. We had a conference not too long ago, and that was a big topic that we had. And there's a guy who's created a calculator that essentially has calculated what it looks like, how much UBIT you're going to end up paying when you do these multifamily deals. That's all he did. So he ended up creating a calculator for himself. And just to make a long story short, essentially when you run all the numbers, because if an IRA is paying taxes, it also can take advantage of depreciation. So when you run all the numbers, it actually doesn't end up being too bad. For just a quick number, if I saw an example of someone making $60,000 in investment, and they paid $12,000 taxes. It's not that bad, and you're still making tax-free money if it's done in a Roth, or tax-deferred money in a traditional IRA. So it's still just a great opportunity, I think. But so never be scared of it. Just aware of the UBIT.
Right. Again, finding a CPA that knows this stuff, and then they're not having to go research it for you, I think is important. So again, we've got a list of CPAs too, and accountants who specialize in real estate tax strategy, and they know this stuff already. They don't necessarily have to go learn it for you. Okay. Hey, Ryan, thanks for the kind words here. He wants to know, should I transfer? He already uses a self-directed IRA company. Should I transfer, or do I have to stay with my previous one? Juan, do you have a customer service department that picks up the phone? So maybe it sounds like Ryan's current intermediary isn't maybe doing a great job.
Yeah, Ryan, give me a call right now. I guarantee you get a person. I may not answer it because I'm on this webinar, but if you called right now, I guarantee you someone will answer the phone. You will get a person every single time. We don't have any automated messages. So that's kind of one of the things we pride ourselves on, to be completely candid. We're a company of 120 people, but our main focus is customer service. And so we can discuss that offline and stuff, but yeah, ultimately, if you're not satisfied with the customer service in the place, we can discuss things. It is very simple to go from one custodian to another. It's not a difficult process. If you have investments or current active assets, I would be wary of maybe fees that your current custodian charges to transition assets, because transitioning assets is not as simple as cash. So just completely candid there, that there may be fees involved if you are a very active investment or investor.
Okay. All right. Jag wants to know, is everyone eligible to set up a health savings account? What if you have a low deductible health plan?
Yeah, so not everyone's eligible. You have to have a high deductible health plan in place in order to contribute. So theoretically, if you were to set one up because you have a low deductible, you would not be able to, if you contributed, you'd basically be in the wrong and then penalize you for doing so. So definitely have a high deductible health plan. Now, what number that is not, it's like a number thing. Double check with your insurance plan. And the question you can ask is, are you HSA compatible? If the answer is yes, then fantastic. But typically, like for example, my deductible is like above $5,000. So, and I have an HSA. So if it's lower and you're kind of in the lower deductible area, probably not. What's nice is that if you are in a high deductible health plan and you've been for a year or more, and then you transition out of it, your HSA doesn't go away. It's not like an FSA plan where you have to use it or lose it. It will just stay there, and you can continue investing and utilizing it, but you can no longer contribute and add funds to it.
All right. Okay, going back to your example of the family that bought the rental property, would they need to pay income tax on the rental income?
So no, well, let me rephrase that. As long as the investment, the asset, continues under the name and the ownership of the IRA account, all the rental income and any income associated with it would come back to the retirement accounts. The taxation will not apply. Not even a sale of an asset would apply taxation. It would just all go to the retirement accounts. But when taxation does apply, is that you receive $100 to your Roth and you want to take money out of the account, that's when potentially taxes apply. In a Roth situation, it shouldn't. However, if you're below 59.5, which is the retirement age, you would pay taxes. So in a Roth, if you're above 59.5 and you took the money out for personal reasons, you're free and clear. If you're before, you're going to pay penalty and potential taxes. In a traditional, where most of the people have their money, you will pay taxes even if you're 65, because what you've been doing thus far is deferring taxation. And the tax rate is not a capital gains. It's not anything like that. It's actually just your federal income tax rate. So if you took out $10,000 of your retirement account in a traditional IRA, tack on 10 grand to what you made that year, and that's going to be what you're taxed at.
Right, awesome. Okay, I'm looking to privately lend to a borrower for a family home flip. Does your company allow a promissory note withdrawals? For example, a certain amount would be released for settlement, followed by a draw when some progress or repairs are done to my satisfaction. One of the companies seems to not allow draws and recommended a separate note for each draw.
Yes, we do allow draws. Separate note sounds like too much work. What would happen is if you had a $30,000 note, for example, and you only want to do $10,000 at each point, at the time of funding, we have a form called direction of investment. You would say funding amount is 10 grand, even though total amount is 30 grand. And then when you want to set the second draw out, you would still fill out another direction of investment associated with the same asset for the additional 10 grand. So you would do a form for us every single time, but it's not a new note. It's just an additional capital towards the investment. So the answer is yes, you can do draws, and it's very common.
Excellent. See, Juan, you're answering these questions so well. They're going to get progressively harder and harder. That's what happens when we get someone so knowledgeable on.
Dump me. Hey, I'm kidding. Make it easy.
Yeah, you gotta be careful with this group. We got some real savvy people on our webinars sometimes. Okay, we'll do a couple more here. I know we're just coming up to the hour, so if someone's got to bounce, we'll get this replay posted tomorrow so you can hear the rest of the Q&A session. But I think we can get through the end of these here in the next couple minutes. how can I protect my asset, home that I purchased with my IRA from lawsuits since the house in the self-directed IRA has essentially 100% equity, no mortgage? It's a big target for a lawsuit. Can I turn the IRA into some other entity to protect the home?
Yeah. So great question. This is very similar to going back to that checkbook answer, because it relates in the sense that you would have to just utilize an entity. So I definitely see, or I've spoken to attorneys that have structured investments for IRA investors to create essentially a holding company, an LLC that can be the one managing these investments. So definitely a strategy is definitely to utilize an LLC, maybe even like an S corp, a corporation, a C corporation. I don't know why, but maybe the attorney would advise it. So you can use other entities to kind of shelter those investments. Definitely, some clients even go as far as opening up different accounts to own different assets. Don't hugely recommend that, because then you have like a bunch of assets that we're administrating and there's different fees for all of them. So if you can do the entity route, absolutely, it'd be a consult with your attorney and try. And if you're working with a specific custodian, see what their prior policies are. For example, us, you wouldn't be able to be the manager of that LLC or trustee of the trust, but there is strategies and ways to get around that. But some custodians do allow that, and that would be easier. So definitely consult with who your custodian is, but there's definitely ways to get the trust or LLC set up for asset protection.
Great. Okay, Stephanie wants to know if she's the only person, that she's acquired the asset with in her retirement account, can she continue to contribute to the account and grow it for future expenses or to buy more assets?
Yeah, so if I understand correctly, you have an IRA, you own a property or an asset, and it's a question, can I continue to contribute myself? Absolutely. I mean, as long as you have earned income, you can contribute, right? You are subject to your limitations. So if it's a Roth, $6,000 or $7,000, depending on your age. But yes, you can continue to contribute. You can actually even contribute past age 72. Before you couldn't. And now, as long as you keep earned income, you can be 100 years old and always contribute to these plans. The earliest you can contribute for the year is January 1st. So when we're in that time frame between January 1st and April 15th, there's a lot of people who contribute for the previous year if they hadn't, because they still can, and for the current year. So just understanding that your contribution, deadline is April 15th.
Okay. This question says, can we only use Roth IRA, not traditional?
No, you can use any account you want. Yeah, we talked about 7 accounts today. You can use them all. So I don't know why you have all of them, but you could.
Sounds like you have a few, Juan. I don't know.
I have a Roth and an HSA, but yeah, all 7 would be a task, and I feel like some of them wouldn't be no reason to have all, but yeah.
Okay. Okay. I hesitate to ask this question, but I'm going to go for it. Can you confirm that it's acceptable by the IRS to self-manage if you have just one asset that you're managing within your self-directed IRA? You addressed this saying, I think if it would be okay if you just had one, but we need to be certain. Elaine, again, I think you need to consult with your CPA, the people who are in your corner that help you interpret the tax code and give you guidance on it to make a decision that you feel good about.
Yeah, I can't confirm, but I can probably add some more clarification on my personal thought process. And this is coming from conversations I've had with attorneys, so I'll share kind of what I'm thinking of. I think the problem becomes what you do on a day-to-day operation. So for example, if you are working for corporate America and you're in the world of oil and gas and you happen to have a self-directed IRA investment and you're owning a real estate property, or maybe you're doing a flip or whatever it is you're doing, it may not bring IRS eyes and you can manage that property all you want. But if you're an individual who has a property management company and that's how you put food on your plate, then at that point in time, if you're also doing rentals in your IRA, multiple, then it's more of a red flag for the IRS to say, hey, you're running your business, your day-to-day business in your retirement account to escape taxation. And that's kind of where it comes into play, right? Like I mentioned, they're not in the bushes and everything's up for interpretation. So It's hard to tell. So I believe that if I did a rental property and I was the one kind of just in communication with the tenant, I'm probably not gonna get in trouble. But yeah, if you were starting to run a business, that's where the issue comes into play. And it actually wouldn't even be prohibited to run a business it would just cause taxation, which would completely void the reason why you're using the IRA at that point, because you're running a business in the IRA. All of income is subject to taxation, and the taxation is a higher rate than even corporate tax rates. So you don't really want to run a business in an IRA.
That's an interesting distinction. That kind of was a light bulb moment for me. It's like you're prohibited to run a business within this investment account. It still needs to be a true investment account.
Right. So it's kind of, and it's kind of coming to me, my conversation with a CPA. See, I have my tools in my tools belt too. Is he always talks about the intent. What's your intention?
Right.
And so I think that's a key thing, and that's exactly what the CPA told me. So definitely get with your counsel, but it's a very gray area.
Yep. Well, and you might have a more conservative counsel, or you might have more aggressive counsel. I mean, if you don't like the answer your CPA is giving you, then maybe consult with some others and see if you get to the answer that you want to hear, I suppose.
Yeah, I guess.
Okay. Let's see. Okay, I think this is a good one to kind of close out on, Juan. The question is, what is the process of purchasing a property within an IRA? So can you kind of walk us through, like, when does somebody need to set this up? I mean, do they need to set this up first and then go shopping for a home or an investment type, or do they find the investment type first and then go set this up? What's kind of the general timeline or process for this?
Yeah, absolutely. Great question. So the ideal situation would be having the investment in sight, and having probably 30 days to figure everything out IRA wise. The reason why it's kind of the ideal scenario is because 30 days is more than enough time to typically transfer funds over and set up the account and get paperwork established. And by the way, when I say paperwork, it's not going to be any different paperwork than if you were buying the property yourself. It's just the name is changing on who's buying the property. So that 30-day window is going to give you more than enough time to do all the processes you need to do to set up your account and then immediately deploy the funds. So why is that an ideal situation? Because that individual will be able to deploy their funds almost immediately, and there's no time wasted. There's no funds doing nothing. Your money's always working for you. However, it's not an ideal world all the time. So there are very circumstances that, you might find a deal and you have a week to close. If you don't have an IRA set up and funds transferred where they need to be at the custodian, and you need a week to close, or you have a week to close, it's going to be a very tight turnaround, and you probably won't make that deal. To be completely, I don't think there's any custodian that can do it that quickly, because what typically happens is it takes you 24 to 48 hours. This is our timeline: 24 to 48 hours to open your account, more on the 24-hour side. It takes you next the transfer / maybe rollover, which can vary. Someone with Wells Fargo is going to take a lot longer than someone with a Fidelity, because their processing times are different. So the average, I say, is give yourself 2 weeks to move money over. A quick custodian is within 5 business days. A slow one is above 10 business days. So maybe you can even ask those questions beforehand to your company and see how long do you process transfer outs. So giving yourself that time frame is nice. And so let's just say it took 5 business days, and then what happens is we can fund an investment within 48 hours of your investment paperwork submitted, and it's green lighted, meaning it's written correctly. If you give us a purchase contract and it shows your name and not the IRA name, we're going to send it back and say, hey, it needs to show the right name. So if they're good to go within 48 hours, we can invest in it. We can do that simultaneously while we wait for money to arrive, so we're not just twiddling our thumbs until that happens. So we can work quickly. But in ideal scenarios, if you have something in sight and you have at least 30 days or something of that sort, you should be good. And I know, for example, in real estate, maybe more difficult, but syndications, those have typically timelines and deadlines to meet. So you know that already. So if your deadline, for example, for an investment was October 31st and you were trying to open an account today, I would say it's possible, but we're going to have to do paperwork now. So.
Good. Well, I mean, I think I tell people this even when it comes just getting pre-approvals and getting financing. Like, don't wait for the opportunity that you're super jazzed about to put together the funding strategy. Yeah. Always keep yourself in a position of being prepared and ready. So Juan, this was super valuable. I really enjoyed this conversation. I might be signing up for some of the education that you guys do, because I feel like there's so much about this that I still feel like I'm continually learning. If you advance to the next slide for me, on the topic of opportunities, and wanting to know where are the deals that might provoke you to want to self-direct your retirement accounts. Real Wealth, I mean, is your network to help you find those investing opportunities. Many of you have heard Kathy Fecky, our founder, mention about the Dallas fund that we're doing in our sister company, Grow Developments. We're partnering with our property team in the Dallas Metro to do a fund. So this is, essentially a syndication. You get to be a completely passive investor. I mean, Juan said it too. Syndications are kind of I think that's kind of the preferred investment type for a self-directed account. And if you like what Real Wealth does, if you like owning assets, hard assets, then investing in one of our funds is a great way to do it passively. So if you want more information about the Dallas fund, you can visit growdevelopments.com, or you can send an email to syndications@growdevelopments.com with specific questions. But Kathy Fecky and our partner in Dallas, they've recorded several videos kind of giving overviews of what the fund is going to look like, how we're structuring it, and you can find all of those on growdevelopments.com. So be sure to check those out. And then as always, if you're looking at just acquiring a rental in any of the markets that Real Wealth is in, your investment counselors would be more than happy to hop on a call with you and talk about different markets and the inventory that we're seeing in those areas. If you want to own the hard asset yourself in that account, we can definitely connect you with super solid operators in about 18 different markets across the country. We can help you get into those assets. All right, Juan, I think you can advance 2 slides then, because we already did the questions. And that should end it for us. Yep. So again, I'm most appreciative. Thanks so much for joining us today. I'll give you the final stage if you want to give us any closing remarks.
Yeah, I mean, honestly, you guys are in a position that is kind of giving you something on a silver platter, and just as long as you understand, what options you have, and ultimately anyone on this call that wants to invest, with those opportunities that Real Wealth has, can do that within the retirement account. And it's just a matter of getting on the ball, getting that working, and share that information with friends, families, and networks, because not a lot of people know about this stuff. You guys are ahead of the game, learning, and Real Wealth did not pay me to say that. So I'm serious. That funds are so cool and so easy and so passive for IRA investors. There are a few I have my eyes on, but I'm waiting to meet those minimums, so I'm working my way there. So yeah. Thank you for your time, guys, and thank you, Leah, for hosting.
Yeah, Juan, it's been a pleasure, and thanks to Quest Trust. All right, guys, we'll get this replay up on the Quest Trust page and our YouTube channel by tomorrow afternoon. Thanks for joining us. See ya.